Right now, somewhere in the world, a central banker is staring at a screen full of numbers that do not add up. A factory manager is delaying a hiring decision for the third month in a row. A family is quietly moving money from a brokerage account into a savings account they have not touched in years. None of these people are panicking, but all of them are paying attention. And by the end of this video, you will understand exactly what they are seeing, why it matters, and what you can do about it before the window of preparation closes. Let us begin with what the data actually says right now in early 2026, because the picture is far more nuanced than any headline can capture. The United States economy grew at roughly 4.5% annualized in the third quarter of 2025, powered by resilient consumer spending. But that momentum has unmistakably decelerated. Deloitte's baseline forecast projects real GDP growth of just 1.9% for 2026, down from roughly 2% in 2025. Real consumer spending, the engine that drives nearly 70% of the American economy, is expected to slow to 1.6% this year, a meaningful decline from 2.6% the year before. The Congressional Budget Office, in its outlook published just days ago, forecasts the unemployment rate holding at roughly 4.6%, while inflation, as measured by the Personal Consumption Expenditures Index, is expected to ease only slightly from 2.8 to 2.7%. That is not a crisis, but it is not comfort either. It is the kind of slow, grinding deceleration that historically precedes either a soft landing or something considerably worse. J.P. Morgan Global Research currently assigns a 35% probability of a United States and global recession in 2026. Goldman Sachs places it lower, at roughly 20%. The New York Federal Reserve's own model shows about a 20% chance of recession by December of this year. These are not trivial numbers. A 1 in 3 or 1 in 5 probability of recession means that the risk is real enough to demand preparation, even if the base case remains modest growth. Now let us examine the specific warning signals that have economists and institutional investors on alert. The first is the labor market. January 2026 payrolls came in at just 130,000. And while the unemployment rate ticked down slightly to 4.3%, the underlying trend is concerning. Between December 2024 and December 2025, youth unemployment for those aged 16 to 19 rose from 12.3% to 15.7%. For those aged 20 to 24, it climbed from 7.5% to nearly 10%. Young workers are often the first to feel the effects of a slowing economy, and this deterioration is a leading signal that hiring appetite is weakening. The monthly average for job creation in 2025 came in around 50,000 positions in the final months, a fraction of the pace seen in 2023 and early 2024. The second warning sign is debt. Total United States household debt reached $18.8 trillion at the end of the fourth quarter of 2025, according to the New York Federal Reserve. Aggregate delinquency worsened, with 4.8% of outstanding debt now in some stage of delinquency. Credit card delinquency rates at 90 or more days past due are holding near 2.57%, essentially flat but elevated compared to pre-pandemic norms. Globally, household debt rose by about $4 trillion in the first 3 quarters of 2025 alone, reaching nearly $64 trillion according to the Institute of International Finance. Total global debt remains above 235% of world GDP. The United States federal deficit is projected at $1.9 trillion for fiscal year 2026, growing to $3.1 trillion by 2036. These are not abstract numbers. They represent a system that is leveraged to a degree that leaves very little room for error if economic conditions deteriorate. The third and perhaps most discussed signal is the behavior of the yield curve. After remaining deeply inverted through much of 2022 and 2023, the 2-year to 10-year Treasury spread normalized by late 2025, steepening to positive territory. As of early 2026, the curve sits at its steepest levels since November 2021, with the 2 to 30-year spread reaching 139 basis points. Historically, it is not the inversion itself that signals the recession, but the re-steepening that follows. Every major recession in the past 4 decades was preceded by a yield curve that first inverted and then normalized. We are now in that normalization phase, which means the clock may be ticking. This does not guarantee a downturn, but it places us in precisely the historical pattern that has preceded recessions with roughly 87% accuracy, according to research compiled by Y-Charts. The fourth signal comes from trade policy. The tariffs enacted over the past year represent the largest effective tax increase as a percentage of GDP since 1993 at 0.54%. The CBO projects that current tariff policies could generate up to $4 trillion in customs duties over the next decade, but the cost to growth is substantial. Tax Foundation analysis estimates that imposed tariffs will reduce United States GDP by 0.5 percentage point before accounting for foreign retaliation. Thomson Reuters projects the average household will face roughly $1,600 in additional costs in 2026 as tariff effects flow through to consumer prices. The average effective tariff rate stands at 16.8%. These policies create uncertainty that depresses business investment, disrupts supply chains, and raises costs for the small businesses that account for 97% of United States importers. Now let us widen the lens beyond the United States. The United Kingdom is projecting GDP growth of roughly 1.2% in 2026, stuck in a band of 1 to 1.5% growth that reflects high household savings rates and persistently low productivity. RSM projects growth of just 0.8% when accounting for fiscal contraction and weak consumer and business sentiment. While a full recession is not the base case, the margin of safety is thin. Across the channel, the Eurozone manufacturing sector recorded its third consecutive month of contraction in January 2026, with the manufacturing PMI at 49.5, below the 50-point threshold that separates expansion from contraction. Germany's manufacturing sector has been in contraction for extended stretches, though January showed tentative signs of stabilization, with output returning to modest growth. The European Central Bank's survey of professional forecasters projects Eurozone GDP growth of just 1.2% for 2026. Canada finds itself in a particularly fragile position. The economy contracted in 2 of the last 3 quarters, placing it officially on recession watch. Its manufacturing sector has been in recession for 32 consecutive months, the longest stretch in a generation. Export Development Canada projects GDP growth of just 1.2% for 2026, with fiscal measures expected to provide barely enough support to avoid an outright recession. Russia's economy presents a starkly different picture. The IMF slashed its 2026 growth forecast to just 0.8%, among the lowest outside the pandemic years and the 2014 sanctions-era recession. Multiple Russian think tanks have warned of recession as military spending strains the broader economy. The central bank holds interest rates at extraordinarily elevated levels, and regional economic depression spreads through smaller cities and industries not connected to the defense sector. So where does this leave the Federal Reserve and monetary policy more broadly? The Fed held the federal funds rate at 3.5 to 3.75% at its January 2026 meeting, pausing its easing cycle. Markets are pricing in roughly 2 additional cuts for the year, but the Fed's own language emphasizes that inflation remains somewhat elevated and the path forward depends on incoming data. Vice Chair Jefferson stated in early February that he sees signs the labor market is stabilizing and inflation can return toward the 2% target. But core inflation stripping out food and energy is forecast to stay firmly above 2% through much of the year. This creates a policy bind. Cutting rates too aggressively risks reigniting inflation. Holding rates too high risks tipping a weakening labor market into contraction. The stock market adds another layer of complexity. As of January 2026, the S&P 500 is estimated to be overvalued somewhere in the range of 123 to 201% above fair value, depending on the metric used, according to Advisor Perspectives analysis of multiple valuation indicators. The forward price-to-earnings ratio remains elevated. Morgan Stanley's target of 7,500 for the S&P 500 implies continued confidence. But firms like BCA Research have warned that a downturn scenario could see the index fall to between 4,200 and 4,500. Whether you find the optimistic or pessimistic case more compelling, the consensus view is that elevated valuations leave the market vulnerable to negative surprises. So what do you actually do with all of this information? The answer is not to panic. It is not to sell everything and hide cash under your mattress. It is to prepare methodically, because the difference between people who are devastated by recessions and those who emerge from them stronger almost always comes down to preparation done before the downturn begins. The first step is cash reserves. Financial advisors consistently recommend maintaining 3 to 6 months of essential living expenses in a liquid, accessible account. If your job is in an industry vulnerable to economic slowdowns, such as discretionary retail, real estate, or financial services, you should consider extending that to 9 or even 12 months. High-yield savings accounts are currently offering rates above 4%, which means your emergency fund can earn meaningful returns while remaining accessible. The second step is debt management. High-interest debt, particularly credit card balances and variable rate loans, becomes dramatically more dangerous in a downturn because your income may decrease while your interest obligations remain fixed or increase. Prioritize paying down the highest interest obligations first. If you hold a variable rate mortgage, investigate whether refinancing into a fixed rate makes sense at current levels. In the UK and Canada, where variable rate exposure tends to be higher than in the United States, this step is particularly urgent. The third step is income diversification. Recessions do not destroy all economic activity. They redistribute it. Identify skills you have that could generate income outside your primary employment. This is not about launching a side business overnight. It is about ensuring that if your primary income stream is disrupted, you have alternatives already in motion. For those who are employed, now is also the time to invest in skills that make you harder to replace, whether that means certifications, additional training, or expanding your professional network. The fourth step is investment positioning. This does not mean timing the market. Study after study confirms that attempting to time market entries and exits consistently destroys returns over time. What it does mean is reviewing your portfolio allocation to ensure it matches your actual risk tolerance, not the risk tolerance you imagined during a bull market. If a 30% decline in your equity portfolio would force you to sell at the worst possible moment, your allocation is wrong. Rebalancing into a mix that includes quality bonds, dividend-paying equities, and some cash is not pessimism. It is discipline. For those with investable capital, recessions historically create extraordinary buying opportunities. During the 2008 financial crisis, the S&P 500 lost roughly 57% of its value from peak to trough. Investors who purchased at or near the bottom and held for 10 years saw returns exceeding 400%. The key is having the capital and the psychological fortitude to invest when everyone else is selling. That capital needs to be set aside now, before fear takes over decision-making. On the tax and legal front, different jurisdictions offer different tools for recession preparation. In the United States, maximizing contributions to tax-advantaged accounts like 401ks, IRAs, and health savings accounts reduces your current tax burden and builds wealth in vehicles that benefit from compound growth, regardless of short-term market conditions. In the UK, ISA allowances provide tax-free growth. In Canada, TFSAs and RRSPs serve similar functions. For the self-employed, across all these jurisdictions, ensuring your estimated tax payments are current and your business expenses are properly categorized becomes more important during economic uncertainty because audits and enforcement actions often increase when governments face revenue pressure. Looking ahead, the most likely scenario remains modest but positive growth, not a severe recession. But modest growth with elevated valuations, sticky inflation, rising debt levels, and geopolitical uncertainty is a fragile equilibrium. The triggers that could tip this environment into contraction include an escalation in trade conflicts, a geopolitical shock, a sudden tightening in credit conditions, or simply a loss of consumer confidence that becomes self-reinforcing as spending cuts lead to layoffs that lead to further spending cuts. The honest truth is that no one, not the Federal Reserve, not Goldman Sachs, not JP Morgan, can tell you with certainty whether a recession will arrive in 2026. What the data can tell you is that the probability is meaningfully elevated. The margin of safety is narrower than it has been in years. And the cost of preparation is negligible compared to the cost of being caught unprepared. The families, businesses, and investors who treated the calm before 2008 as an opportunity to strengthen their financial foundations were the ones who not only survived the crisis, but used it as a launch pad for the decade of growth that followed. The question is not whether you can predict the future. The question is whether you have positioned yourself to thrive, regardless of what it brings. And the time to answer that question is not when the storm arrives. It is right now.